Stocks, the stock exchange, words that most people don't understand. But what if I tell you that understanding these terms is essential for building wealth? Hi, I'm Financial Frontier, and by the end of this video I will promise you that you will understand more about the stock market than most people, even if you have no idea about the stock market. In short, what is a share? A share is a stake in a company. With the purchase of a share, you receive the right to a profit distribution and also a right to vote within the company. The strength of your right reflects your percentage ownership of the company. This means that if you have fewer shares, your vote automatically becomes less important. Now, some are probably wondering how the price of a share comes about. It's quite simple, and as usual in a market economy, the price is determined by supply and demand. This means that when the demand for a share increases, the price of the share increases automatically. If the demand falls, the price also falls. The percentage change you make in a stock over a year is called annual ROI, which basically means return on investment. Very simple example, if you buy an Apple stock for let's say $100 in 2020 and a year later it's worth $150, you can say that the annual ROI on that stock is 50%. But where are these shares traded? The stocks are traded on a stock exchange, which you can think of as a market. But instead of groceries, shares are traded here. You no longer have to be present at the stock exchange as used to, but thanks to digitization, you can do everything easily from home. Both sellers and buyers meet here and negotiate a price that is now automatically determined by computers depending on supply and demand. Now, many people are probably wondering how to buy a stock. All you need is a stock account, which you can open at your bank or at dozens of other providers. To register, you only need to be 18 years old and have an ID card. That's it. You can imagine your stock account as your virtual wallet with which you are able to buy shares. I mean, try shopping at a market without your wallet. Depending on the bank or provider, there's also a fee per trade, meaning per purchase, which can vary from $1 to $10 or more depending on the provider. From a tax point of view, taxes are usually only levied on profits, which vary greatly from country to country. But anyone who thinks you can just buy shares of individual companies is wrong, because there are still so-called ETFs, also known as exchange-traded funds. These include several companies, depending on the case. With this you can invest in entire markets, which of course contain a large number of companies. The advantage of such diversification is, of course, that you can invest with less risk. In general, you can expect significantly lower losses with ETFs than with conventional shares, because, for example, with a single share you have the risk that the company will do poorly and thus make losses, which of course also affects the shareholders directly. This shouldn't be a problem with an ETF, since individual weights are weighted very weakly and therefore have hardly any influence on the course. Nevertheless, it must be said that both the losses and the gains are mitigated. Still, ETFs outperform most individual stocks over the long run. With these ETFs, there's also only a small fee which in no way affects the profit. There are two ways to benefit from this. On the one hand, you can buy a stock or an ETF and sell it after some time to take the profit with you. The other option would be to benefit from a so-called profit distribution, also known as a dividend. This dividend is determined each year by the company. But it's also possible for a company to not pay a dividend at all, such as Alphabet, Google's parent company, does. The dividend is given as a percentage, which means, for example, a company can set its dividend at 2%, which means that you only receive 2% of your total invested amount once a year. That means if you invest $100 in a company, you would get $2 each year, which will be then taxed again. This means that through these dividends you can build up a passive income and make profits without selling your positions. Now that we've gotten through the basics, I want to give you a few more tips along the way. First of all, as I said in the last video, investing is a long-term activity. So don't make the mistake I did and don't immediately sell positions just because you've made a small profit or because you made a slight lose and are afraid of losing more. Because I put it this way, perseverance is not only rewarded very well on the stock market, but also generally when investing. Because in the long term, our global economy is growing continuously. Of course, there are some crashes like the corona pandemic, but these losses are completely gone after 2 or 3 years at the latest. This means that in the long run, you will always win. And guys, believe me, don't think yourself too smart and don't start trading. By trading, I mean buying and selling often. To be honest, that's exactly what I did at the beginning of my stock market career, because I thought I was too smart and had the quick money in my mind. End of the story, I've lost a lot of money. On the one hand, the constant fees, including taxes, are very high, so that the profit is usually very small. In addition, hardly anyone always managed to get into a stock perfectly, which means that you are simply doomed to lose. So believe me, guys, just don't do it. So that's it with this video. As always, I hope that you liked this video and that you were now able to understand the stock market and everything around it. But remember, these information are just the basics, and also remember, investing is a long-term activity. Please leave a like and subscribe so you don't miss any more videos. That's it from me, and thanks for watching. Bye.